What's up, YouTube? Back at you again with another video. This time it's a request by my friend Steven from work. So I'm just gonna talk a little bit about ETFs and mutual funds. I've been doing a little research. I know we both got into Acorns, and that's an ETF. So I know you want to know a little bit more about that. So I did a little research, and here's a quick video. So let's talk about mutual funds and ETFs. I've personally owned a mutual fund and an ETF. I've had my mutual fund for about a year and my ETF for about a month and a half. So it's fairly new. I'm fairly new to learning about ETFs. I don't claim to be a professional. I'm just researching, learning, watching videos, doing my research, talking to people, learning what I can. So let's talk about what is a mutual fund. It's basically an investment vehicle made up of funds from different investors with the purpose of investing in securities such as stocks, bonds, and other assets. Now, the big thing you have to realize about a mutual fund is the second bullet point, and that is that it's managed by a money manager. This person invests your money, and he tries to make capital gains for you. I mean, that's pretty much his whole job. Mutual funds are kind of like ETFs. To me, they go hand in hand. I mean, they both you can use as you can consider them basically like a pie chart, and how it's broken down into different asset classes. Even though ETFs are use indexes, but I mean the mutual fund is broken down in different asset classes, and your money is pretty much invested in all of those. It's kind of like a bubble with a whole bunch of stocks in it, basically. That's pretty much the best way to say it. So what's the pros and cons of mutual funds? The pros: diversification, affordability, professional management, liquidity, flexibility, and investment size. So diversification, because like I said, you're investing in this big bubble with a whole bunch of stuff in it, and it's diversified. The saying in stocks is never put all your eggs in one basket. Well, a mutual fund is the prime example of not putting all your eggs in one basket. Affordability: mutual funds are pretty affordable. I think my first mutual fund that I got was like it's like 50 or 60 bucks, which is nothing these days. People spend that money on buying shoes. Cost that more than that nowadays. So yeah. Professional management, because like I said in the PowerPoint, the slide before this, your money is managed by a professional, so that's his job. And it could be a good thing or a bad thing. And liquidity, because you can get the money out anytime you need to get it out. It's not like an IRA or a retirement investment where your money has to sit there. You can actually put the money in and get the money out, and that's what makes it pretty flexible. And we'll go into flexibility, because I mean, being able to get your money in and out in the time of need is what it's really about. But I would suggest that if you're investing in stocks, just sit it and forget it. Leave it in there for the long haul. I mean, that's pretty much the only way that you'll really gain capital gains and growth in your money, is to leave it there for the long haul. And investment size, because with mutual funds you don't need a lot of money to invest. You don't need 10 or 15,000. You can invest, like I said, with 50 or 60 bucks is how I got my first mutual fund. And the cons are return on investment depends on the skill of the manager. That's the bad part about mutual funds. Well, one of the bad parts. I mean, of course it's managed by a professional, but you have to also remember that that's a human being and they make mistakes. So if they are not on their A game when it comes to investing your money, you can definitely lose money. Another thing I don't like is the fact that it trades once a day, usually at the end of the day. It's not like regular stocks that trade throughout the day, or ETFs that trade throughout the day. Another thing is mutual funds have higher expenses, and I learned that when I got my first mutual fund, not doing research, just trying to jump in because I was like, oh, it's a mutual fund, and I incurred a higher expense. yeah, so sometimes those expenses come at the beginning when you first buy into the mutual fund, or they'll come after your first quarter gain. But trust me, those expenses and fees will come. So yeah, that's another thing about the capital gains. You don't realize that it's a thing called shorting the market, or shorting the stock, or you short in general. And when you buy a certain stock, and you get capital gains on that, and then you sell it, you pretty much just short the stock if you don't hold it for like a year. It's not considered a long-term investment. When you buy into a mutual fund, no matter when you buy in, you'll get capital gains on that, which will be taxed at a higher price because of the fact that it's kind of like shorting the market when you first get in and you're getting capital gains. But yeah, higher expenses at the very end, because you do have to realize that mutual funds have very high expenses in terms of relating to ETFs, because they don't. So talk about the pros and cons of ETFs. Liquidity, volatility, market orders may be used, diversity, tax efficiency, and some ETFs also offer dividends. So I know my ETF that I just got like a month and a half ago has actually paid me a dividend already. Now it wasn't much, but it was good to know that I put my money into something and I immediately got a return. I'm still not sure if the ETF pays out dividends quarterly or monthly, because some pay out quarterly, some pay out monthly. Tax efficiency, because with ETFs you have to realize that the ETF is being traded between the sellers and the buyers, so it's pretty much like no capital gain taxes were ever made, and that's pretty much how ETFs are very tax efficient. And diversity, mutual funds and ETFs are pretty much the same when it comes to this. You have to know that when you're putting your money into these ETFs, you're getting a slice of the pie of whatever asset that you're trying to gain money from, whether that be currency, technology, or the housing market. So that's pretty much how you diversify your portfolio. By getting into a mutual fund or ETF. Market orders may be used. So if you have an actual brokerage account, you'll know the difference between stop losses and buying and shorts. So I mean, for example, if you had an ETF and it got down to $20, you can say, when this ETF gets down to $20, it'll be a box up in there where you could put the amount, and you can put sell, and it'll be when it get to $20 you can sell this ETF. So that's pretty good, because you can't do that with mutual funds. But also I realized that a lot of ETFs you can and you can't do that with either, but at least you get the option with some, because in mutual funds you don't even get that option. And volatility, because of the fact that you have to realize that when you're investing in ETFs, you're invested in one asset pool, so your money's not going to dramatically go up and down, even though it's diversified, but it's all diversified in that one category, if that makes sense. So it's either going to go up a little bit or down a little bit, but it won't go down dramatically being invested in different things as it would be in a mutual fund. And liquidity, because you can get your money in and out just like in a mutual fund, but I would advise against that. I would say that if you're investing in ETFs and mutual funds and stocks, to be around for the long haul, man. Those are where the gains are made. The gains and the compound interest and the dividends are made being around for the long haul. Don't watch your money go up and then just decide to pull it out. So commission and trading fees, but I mean, this is pretty much really not a con, because this is with anything: mutual funds, bonds, stocks, all of that. They all have commission and trading fees, but I would say this: ETF fees are definitely very lower than mutual fund fees. And I can give you an example. My ETF, it only costs me $1 a month. That's my fee. Unlike a mutual fund, which could be 2, 3, or 4, 5% of the whole mutual fund. And then the next bullet, the unknown index factor, which this is not all ETFs, but this is some of them. You don't pretty much know where your money's going into, so that can be the bad thing. Which ETF is it trading against or trading towards? If you have some of these ETFs, they do give you the option to actually see where your money's going, and the type of ETF is going to be. It'll give out a detailed description, and those are the ones that I would shoot for if I were you. And another kind is it's passively managed, so it's basically like an index, and it's not like a mutual fund in terms of you have a money manager managing your account. You actually just sit it and forget it. I mean, I have both, but I personally prefer the ETF over the mutual fund. And the bottom line, ETF is simply a basket of securities that provide you with a slice of ownership in each component within the basket. ETFs are similar to mutual funds but trade readily like a stock, so they provide excellent liquidity for investors. So I mean, the question that I got from Steven was, I guess, to do a video on it, and I give my take of which one is better. And I'm pretty sure you already know right now, I like ETFs more than I like mutual funds, and we've already had this discussion why. Yeah, but I would say do your own research, learn more about them, and realize that it's money to be made in both of them. And if you want to be want your money to be actively invested, you would pick a mutual fund. If you want to sit it and forget it, you will pick an ETF. They both have key points that make them strong and reliable, I guess you could say, shares. Like I said, I personally like the ETF, and that's what I'm sticking with. You already know the one that we use, and that's the one that I'm liking right now. I'm gonna dig into a few more, probably the iTech or the iShare, the tech one. I think that'll be a pretty good one to get into. So yeah, that's pretty much what I'm gonna do. Also remember to like, share, and subscribe, man. I'm doing these videos to help young people out as myself. I mean, the more video requests I get and the more things you ask me to make videos on, the more research I do, the more knowledge I know, and the more knowledge you'll receive from me doing the videos. Everything that I talk about is going to be in the description, so you can do your own research. I'm no CPA. I'm not certified to give you any kind of financial advice. Do realize that when you put your money in the stock market, it's liable to go up and down, and I'm not responsible or reliable for your money going up and down. These are all just researches that I'm doing, my opinions, my suggestions on things that I like. So yeah, like, share, subscribe. Peace.